Welcome to Boss Talk. I'm Jim Parker, and this is my business partner, Carey Sobel.
Thank you for joining us today. Today's episode is pricing a business for sale. And there is a lot of different methods used to price a business. It's mostly situational. A lot of different brokers have methods that they prefer to use, but it's also contingent upon the type of business that we're talking about. And today we're going to go over some of the basics, answer some questions that you may have about how to price a business for sale. We're going to go through the who, what, when, why, how. But I always like to start with the why behind something. So this topic today, Jim, why is pricing a business for sale such a controversial thing? Why is it such an important thing? Let's just talk about the why of pricing.
Okay, I don't know if it's so much a controversial, but it's the most critical part in the process, obviously. I mean, you look from a seller's perspective, a seller's calling us, they want to try to get as much money as they possibly can for the business. Yep. You know, but at the same time, if you overprice that business, you're not going to sell the business, right?
Yeah, it's going to rot.
Right. You know, what are the averages? 20% of businesses nationwide?
Except for us.
Except for us. Nationwide, 10 to 20% of all businesses for sale actually sell. Now, I sell 90% of the businesses that I take to the market. Carey, you knock it out of the park as well. Mm-hmm. But, you know, if overpricing that business, it's going to sit there in the marketplace.
So you'd say that the number one reason why businesses don't sell is because of pricing?
I agree. I think number one reason businesses don't sell is pricing.
Yeah.
And I think the number two reason businesses don't sell is pricing. And same thing with number three.
I would say
those are the three top prices. But at the same time, you want to make sure that you're not undervaluing the business either, and the seller's leaving money on the table.
So buyer wants to get a deal, seller wants to get as much money as possible.
Yeah.
So you have to find that middle ground, which is the whole part of pricing a business. And I actually believe that a business should be priced at what somebody's willing to pay for. That's what a business's worth is, what somebody's willing to pay for it. Now, all the methods that we use to come up with a business price are just tools that we use to provide a suggestion. At the end of the day, a business sells for what somebody is willing to pay for it. Mm-hmm. So we have to come up with a starting ground, and we use a bunch of different methods to do it. So the why is important because it's really how a deal gets done, but the how is probably the meat and potatoes about what we're going to talk about today.
Right, correct.
So before getting into that, let's address the who. Who prices a business for sale?
Well, obviously, brokers like us, right. You know, we do a broker's opinion of value, and we determine what the most probable selling price of that business is going to be. And then, of course, you got business appraisers out there, and the business appraisers will also do a valuation on the business. You got to make sure that business appraiser has got the proper certifications and, is knowledgeable in their own right. You know, whether you're using a business broker or a business appraiser, you know, you want to make sure you're dealing with somebody that is extremely experienced in doing that, and that's what they do day in and day out.
Sophisticated in their space, and
knowledgeable, has got the experience, et cetera, et cetera.
And when we do broker opinions of value, these can't be used for financing or for institutions. They typically rely on that certified business appraiser, the person who has the certifications. But for us, we're looking at market stats, comps, and different things of data that give us the knowledge and basis to tell a seller, hey, we've studied your business. Mm-hmm. We've studied businesses in your industry. Here is what we think our opinion of value is on your business. And that's typically how we start.
Yeah, correct.
So, let's talk about CPAs in this process. This is a funny one. Now, I have great relationships with my personal CPAs. I have multiple personal CPAs. And we work with a lot of different business owners, CPAs, in this process because we have to gather data. And a lot of times business owners don't know where any of their P&Ls or tax returns or cash flow reports are if they even have them. Mm-hmm. But a lot of times when we talk to a seller, the first thing that they'll say is, well, my CPA told me that my business is worth this.
Oh, yep. I hear that all the time. I hear that all the time, and you do too. I get on the phone with a seller, and they're like, I already know how much my business is worth. And I'll be like, how do you know? And they're like, oh, my CPA told me that my business is worth X amount of dollars. I've been helping people sell businesses for nearly 25 years. I must have heard this 100 times. I think there might have been one or two CPAs in that entire time period that were even remotely in the region of what that business is really worth.
Why do you think that is?
I don't know. I don't know if they're, first of all, they're not, obviously they're not, this is not what they do. They don't value businesses every day. They it's not what they do day in and day out is selling businesses. I don't know if they're reading Forbes magazine and Fortune and they're using multipliers from very, very large publicly traded companies or where they're getting that information from. I don't know. But at the end of the day, what I do know is that 99% of the time when a CPA, when seller says, oh, my CPA said my business is worth X amount of dollars, it's not correct.
Yeah.
Look, they're probably fantastic CPAs. I've got it. They really know what they do. They know, they're really good at accounting. They're much better than I'll ever be at taxes. I mean, that's their field. I don't know what they know, but they don't know what we know.
Exactly. And they are a tool for us to get to our opinion of value because they're providing us the data we need to make our questions. Yeah. They know where, they know some of the things that are maybe considered skeletons in the closet, which we'll talk about later. And, typically what they're doing is trying to reduce the taxable income for their business owners. And then when we come back to the table and say we need to find out the true value of the business, we have to, pull back some of those things, which we'll talk about in a little bit, add backs.
The seller CPA is a critical component in the sale of the business.
No doubt.
We're going to be working with them. Us, the seller, the CPA, we're going to be working together, but we kind of need to stay in our own lanes.
Sure.
And, we do what we do and they do what they do, and we work as a team to get things done. But don't have your CPA. I mean, you can have your CPA give a value, but I would take it as a grain of salt.
Yeah.
No offense to any CPAs out there, but, it's not your field.
And I think the most critical role that a CPA plays in the sale of a business, beyond helping provide the data to provide the value, is post-sale. How is that business owner that's selling their business going to be, affected from a taxable event standpoint? If you sell your business and you have a taxable event, that CPA should be able to help advise you on where you should put your money to help cap gains and so on and so forth. So
I do want to add this too, because we're going back to the business brokers and the appraisers. I wanted to touch base on this. So typically what we do is when we do a broker's opinion of value, we're determining the most probable selling price of that business. And Carey and I do not charge for that broker's opinion of value. And there's no obligation to use our services. If you're going to use an appraiser and you're going to get an appraisal done on your business, and you don't do a full-blown appraisal, but you do it's going to cost you a few $1,000s. So it doesn't cost anything to use our services to do that broker's opinion of value. And like you said, if a seller does go and or business owner does get it appraised by an appraiser, we would not be able to use that appraisal moving forward. If we did find a buyer, we could not use that appraiser's appraisal if the seller orders that appraisal directly from the appraiser.
That would have to go from a financial institution that is mandating or selecting an appraiser. Right?
Exactly.
A third party,
exactly.
Arm's length type of deal.
Exactly. So if we're working with a business owner and they're like, can you do a broker's opinion of value? And we do the broker's opinion of value, and they're like, hey, we also want to get an appraisal done. Great, let's do that. It's going to cost you a few $1,000s. But what we should do is they shouldn't order that. I shouldn't order that. We should go to one of the lenders that we work with and have the lender order that appraisal directly. That way, we would be able to use it. Some banks will allow you to use it up to 6 months. Some banks, I think, up to a year, but I'm not positive about that. So that when we do find a buyer and that appraisal's already been done and it's been ordered through the bank, we can use it for the loan. And then we can talk about, hey, maybe the buyer can split the cost, or maybe the buyer can absorb that cost. Because typically once you go under contract and the bank orders that appraisal to get done, usually it's a buyer's expense.
And we're going to talk about how we value a business or how we price a business in a moment. But in those institutional appraisals, right, from a certified appraiser, they typically point out a bunch of terms and methods that are used to value a business, and they show a bunch of different ones, whether they're used or not. For example, book value and asset value, where it's assets minus liabilities.
Income approach and market approach, and then you're right. And we look, a business appraiser is going to get a lot more detailed in their appraisal reports.
Yes.
That's what they do. It's kind of like if you're selling your house and you're a real estate agent. I hate to use this as an example, but it's a good example to use. You want to sell your house. You could go to a real estate agent. The real estate agent could give you a fair market valuation on that house, and they're going to be really, really, really close because that's what they do day in and day out. And it's the same thing with us. When we do that broker's opinion of value and we give you that most probable selling price, we're going to be like right there because this is what we do day in and day out. And we have access to the comps and et cetera, et cetera. But then, when you're selling a house, at some point, the bank's going to require an appraiser to come in and do an appraisal on that house.
Yep.
And that appraisal is going to be a lot more detailed than what the real estate agent did. And it's the same thing with us.
Yeah.
But it doesn't mean that the final number is, more accurate per se.
Not at all.
At the end of the day, there is a little bit. It's not an exact science at the end of the day.
Yeah.
You're not going to come to an exact number.
And there's no gospel over that number saying, yep, this is the value of the business and everybody believes it. It's black and white. That's just not the truth.
Right.
And, when you started to mention, or we're talking about book value and market value and discounted cash flows, and all of those are relevant. And all of those are tools for us when we eventually put out our broker opinion of value. But the how to price a business, or how to come up with a opinion of value, we're typically looking at a multiplier of either seller's discretionary earnings, which we'll touch on in a moment, or EBITDA, earnings before interest, taxes, depreciation, and amortization. So we're essentially saying the business historically has put off a owner benefit. The owner that owns the business gets a benefit of this amount of number, and that number typically has a multiplier attributed to it to come up with a value. That is the most basic way that we can talk about how we price a business.
And I think let's talk about discretionary earnings, and then we'll talk about EBITDA.
Okay.
And so maybe we could talk about what discretionary earnings is, and it's you as a business owner, what you're trying to do is you're trying to reduce your tax liability. Your CPA is trying to reduce your tax liability. So what Carey and I will do when we come in is, with your help, we're going to unwind all that to see how much the business is really making. Carey, you want to touch a little bit on what makes up discretionary earnings? And I'll jump in too.
Well, the most vivid point of discretionary earnings, first thing you do is you're going to look at what is on the bottom line of the financial statement, right? You're going to look at the tax return or the P&L. And these are two different instruments that provide two different vernaculars. But at the end of the day, whatever is on the bottom line is what the business profit.
The net profit.
Right.
Yep.
So I always say you can only win once. You can win every single year when you reduce your taxable amount and you pay less money into to the government, or you win at the end when you cash out and get the true value of your business. But we have tools and things that we do to find out the true discretionary earnings. So the first point of discretionary earnings is what is on the bottom line of a financial statement. We add things back to that net profit. And that's
to keep increasing that net profit.
Right. So, for example, if I run a business, Carey's Car Wash, and I'm an owner-operator, and I pay myself a $50,000 a year salary, and I have $50,000 a year of net profit on the bottom line. Well, as the owner of the business who pays myself that salary, so far we've come up with $100,000 in net profit.
Net profit $50,000, owner salary $50,000.
Exactly. Now, what other things can we add back to that bottom line? Well, I run my cell phone through the business. I run my health insurance through the business. I have my automobile through the business. And altogether, those things come up to $20,000 a year.
And let's say the automobile, you're not really using it that much for business, but
It's my personal vehicle.
Yeah.
But I put it through the business. It reduces my taxable income. I pay less in taxes. And it is looked at as okay.
And hey, a lot of business owners out there, I'm not saying that it's correct. I'm not criticizing it. It's just a fact of life that, a lot of business owners do put some personal expenses in the business. I do want to say you should try to minimize those personal expenses as much as you possibly can, but it is the reality of that. That is what is happening, and buyers understand that. Lending institutions will understand that to an extent. And that's a conversation that if you're looking to sell your business a couple years out, that maybe Carey and I can talk to you and go through those personal expenses. Say, hey,
pull them back a little bit.
The
cleaner the financials, the easier it is to get a deal done.
Yes.
So back to that reality point of having that on there. So we had $50,000 in net profit. We had $50,000 that I take as a salary, and we had $20,000 in fringe benefits on the business. So that's $120,000 that I make as my discretionary earnings, because it's up to my discretion to put those things as expenses on the business, that if somebody came in and wanted to run the books and the business completely perfectly, those expenses would not be on the business. Right? So that's...
So now we're up to $120,000. And then we can look at things like the payroll portion of the owner's salary. Carey said that, in this example that he was taking a $50,000 salary. we could add back the corporate side of the taxes on that, because the 50 grand that he's getting taxes taken out of that $50,000 he's paying personally, but then the corporation is matching like Medicare and they're matching Social Security. So let's just take in this example that 8% was the corporate taxes. We could add back another $4,000 in the owner's payroll taxes, because at the end of the day, we don't know when the new buyer comes in how they're going to take their money.
Exactly.
We don't know if they're going to take a larger salary and less distribution, or a bigger distribution and more and less salary. It's basically like, this is how much the business is making. You figure out your own tax situation. That's why we add back that payroll taxes.
And that's why it's considered discretionary earnings, because it's up to the discretion of the person operating
Yep.
it. So you mentioned add backs. Maybe we just dive into some add backs now. And add back is essentially an expense that you can add back. And we've talked about personal expenses already. Let's talk about one-time expenses. And let's stick on the topic of Carey's Car Wash.
Okay.
Carey's Car Wash decides that they want to offer an amenity in the lounge for people that come in and they're waiting for their car to be washed. And we put some form of entertainment or televisions or a video game. We have a $5,000 expense. Let's call it a $10,000 expense.
Let's say they built out a really nice lobby, and they built out a really nice lobby for $25,000.
$25,000.
Sounds like a heck of a good car wash.
Yes.
I want to go there.
and it's a one-time expense that increases the value of the business, because customers want to come there now because there's a nice lounge. But the owner put $25,000 of operating expenses from their P&L onto the business that year. That now
And if they're expensing it that year, that's a one-time expense. So it's not an expense they're going to see every year. So we can add that number back.
Exactly. So now we're up to 145.
Yep.
Right. And that one-time expense, they come in the forms of repairs and maintenance. If there's something big that goes down, but not, for a car wash, you're going to have repairs and maintenance every single year, right? So if it's $5,000 one year and $10,000 one year and $7,000 another year, we're not adding that back. That is consistent maintenance.
But all of a sudden, you see that jump up to $25,000, $30,000. We're going to say, why'd that jump up to $30,000 this year? Oh, because we redid the lobby, blah, 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 blah. Okay, that's a one-time expense.
Yep.
So what Carey's saying, you got to keep in mind too, is almost every business has repairs and maintenance. And that's a normal thing. You can't just add back repairs and maintenance. But, if it's a one-time expense that is outside of what it normally is, like you said, that example of, 5, 7, 10, it's kind of floating in there over the years, and all of a sudden it jumps up, that's an unnormal type of a situation.
Yep.
So
on the topic of add backs, let's talk about some other things that we see that are typically added back, whether they're frowned upon or not. I know one item that we talk about often is donations.
yes.
So, there may be one large donation that a company makes one time. We're typically going to add that back. Mm-hmm. But every single year, if Carey's Car Wash sponsors the Little League for $1,000 and they get a banner at the Little League for Carey's Car Wash, that's kind of a cost of doing business, right? You donate to it every single year. If you pull that away, maybe you're not getting the same exposure. So we look at that more as an operating expense than an add back.
Right. That's one of the things I see is that a lot of times brokers just come to the assumption that they see donations or charitable contributions, and they add it back right away. And a lot of times you can add it back if you're donating it to your church and you're not receiving any kind of advertising back. Or you're donating it to the Red Cross or whatever it is. But if you're donating it, you can add that back. But if you're donating it, I'll give you an example. A few years ago, I sold a business. The seller was donating about, I forget, $4,000 or $5,000 or a couple $1,000s a year to a girls softball team. And
it's a hell of a donation.
It was, and it was. And it was actually the competitor. My daughter played travel softball at the time, and it was one of the biggest competitors of my daughter's softball team. They
probably had the nicest jerseys and hats and gear.
Yeah, well, travel softball is expensive, but anyways, I asked the seller about that. I said, "What's that donation for?" And he goes, "Oh, I donated to such and such softball team." And I'm like, well, that seems strange. Yeah. Why are you doing that? And he goes, it's because my biggest clients is the head coach of the team. Well, you can't add that back. That's going to be an expense to the new buyer,
Yep.
right? Because the new buyer is going to come in. You can't go up to your number one client when they come in for a donation that year and go, yeah, no, we're not donating anymore to, your softball team.
It's very
That's your biggest
situational.
client,
Yep.
so you can't add that back.
Very situational. And some other items that are the standard items are, the amortization, depreciation. When we talk about EBITDA, we'll get into that. But some other items that I often see is bank charges. Sometimes there's tons of overdraft fees, or there was a fee to get a loan or something. So there's usually some stuff in bank charges that we look at. A lot of times there is, we mentioned cell phone, we mentioned owner's insurance, health insurance, auto insurance, travel. I personally, when I take a trip, if I have any meeting at all in any way, shape, or form with anybody about my business while I'm on a trip, I will write my trip off.
Yeah, and then again, that's kind of a discretionary type of a situation, and we address that each one on a case by case basis.
Meals and entertainment.
Yep, we see a lot in that.
Office expenses.
But maybe we move on to some other things that we can add back. So we're also going to add back the interest expense, because let's say that car wash has a loan, and let's say the interest expense every year is $15,000. We can add back that full $15,000 of interest expense because that's on a loan. And whoever comes along to buy that business, the seller is going to pay off that loan.
So the business is sold free and clear.
So the business is sold free and clear to the buyer. Just like if you were selling a house. You're selling your house, you're paying off your mortgage, and you're making it free and clear. Now the buyer might have a mortgage when they buy the house, but that's their own mortgage.
Well, it's just like when you, on your personal tax return, all your mortgage interest is a tax deduction, right? So it's the same thing here in business. You may have an interest payment because you missed a credit card payment, right? And maybe it's a large credit card payment. Maybe it's like a $5,000 fee. We'll look at that and uncover that and add that back as well in the interest category.
So we add back interest 100% of the time. We add back interest 100%, and then you've got depreciation.
This is a huge one. This is a huge topic. Most business owners, savvy business owners, or of course through CPAs advice, use depreciation as one of the best tools to reduce your taxable income. If you buy assets, if it's an asset heavy business, you have the ability to depreciate those assets, and that depreciation is a direct reduction of your taxable income.
Let's say you buy something for $100,000, and it's a 5-year depreciation. So every year you're writing off $20,000 a year in depreciation. That's a non-cash expense. You're not actually realizing it that right there in that year. So we add back depreciation 100%.
Yep.
With the caveat, and this is a big one, it depends on the business, because sometimes that depreciation we're going to add back, but then we have to put in a CapEx number. If it's a type of business that constantly needs to be putting money into the company every single year to keep capital improvements going on, we're going to add back the depreciation 100%, but we got to look at a CapEx number of what that is, and that's a conversation that we would have with the seller and the CPA to figure out what that kind of number is.
And CapEx, or known as capital expenditures, as it relates to our example of Carey's car wash, would be a large piece of equipment in the car wash, right? You have to buy a $100,000 piece of equipment that you drive your car into, and it goes back and forth, and you've depreciated it over 5 years. You've added back that depreciation, but now that piece of equipment is getting tired, and you need to buy a new $100,000 piece of equipment. So there's the capital expenditure example applied to the car wash. And these are all nuances that we see every day. And to a business owner who's in their own business, they may not even know about these types of things. So when we're going through and analyzing financials, these add backs, these one-time expenses, whether they're known or unknown, it's our job to educate the seller about those types of things.
Yeah, and keep it away from a challenging situation when we do take it to the market. Because if you just add back depreciation, like some businesses, you add back depreciation 100%, and you add it back, and you don't worry about a CapEx number, and you don't have an issue with it.
I like those businesses.
Yeah, I do too. You make it easy.
Yes.
Other businesses you look at, and you have to have a CapEx number in there, and if you don't, a buyer's going to come along and go, yeah, but you added back all the depreciation, but it's very apparent in this type of business, I'm going to have to invest X amount of dollars every year into equipment just to keep it operating and running.
Yep.
So, and then on a sister note to depreciation, unless you want to mention anything else about depreciation.
No, and I'm excited for you to school me on this one because this is always a challenging one for me. Let's talk amortization.
Amortization, and I call it a sister to the depreciation, because amortization is a non-cash expense just like depreciation is. So we're going to add back the amortization expense 100%. So what do I mean by amortization? Amortization, and if you're a CPA listening to this, oh my gosh, I feel bad because we spent the first few minutes of the podcast bashing them, and now they're going to listen to this part and they're like, "What? They don't know what because this is probably not the best definition." But amortization is just like depreciation, but depreciation, you're depreciating something physical, something solid, something you can touch and feel. Amortization, think of it as depreciation, but you're depreciating something that you can't touch and feel.
An intangible asset.
Intangible asset, such as like a franchise agreement. You bought a franchise agreement for $50,000, and you're amortizing that over X amount of years. It's not something that you can physically touch, because we're not talking about the paperwork you actually sign. We're talking about the concept.
So other items could be intellectual property, trademarks, patents, copyrights.
Or it could be as simple as this: you bought a business 4 or 5 years ago, and you're depreciating or amortizing the goodwill portion of that sale. So you can see that on there.
And I'm sure when we get into another episode talking about asset allocation and goodwill, we'll better define that.
Yeah.
But goodwill is an intangible asset, right?
Yeah.
So we've talked about interest, we talked about depreciation, we talked about amortization, and we mentioned EBITDA earlier, right? Yeah. Earnings before interest, taxes, depreciation, and amortization.
And wait, before we go into EBITDA, I'm so sorry. Benefits such as if you're taking money as an owner through health insurance, you're doing things like you got a 401k plan that you're contributing through your company. Any of that stuff that belongs to the owner, not the employees, obviously, because the buyer's going to have to continue those policies with the employees. But any benefits that you're receiving type like that, we're going to add to that bottom line.
Yep.
So to recap real quick, if it's okay, we're taking the net profit plus the owner's salary, which I don't know if we want to go down that rabbit hole. Maybe we'll go down that rabbit hole
another time.
We'll go down that. Well, let me touch on it real quick in a minute.
Please
But the net profit plus owner's salary plus interest expense plus depreciation / amortization plus one-time expenses plus benefits, that comes up with your discretionary earnings. And before we move on to EBITDA, and I don't want to confuse you guys that much, but when we're looking at that owner's salary, there can be a lot of different things going on how we add back that owner's salary. If it's two owners, for example, when we're doing a discretionary earning number, we're always assuming that whoever buys the business is going to be a single owner operator. That's what you're supposed to do when you're putting a value on a business for sale. So, if you're a business owner out there and you're like, well, the perfect buyer would be a husband and wife team. Okay, you might be right. But first of all, we don't want to slim that pie down that much to try to find that couple. But two, you're going to get an artificial value on that business because you're not comparing apples to apples when we're comparing it to other businesses in the same industry in the same gross sales range. We've all got to kind of look at it the same way. So we're going to assume that whoever's going to buy the business is going to be a single owner operator. So we have to look at both of those salaries. Are they both working full time? Yes, let's say they're both working 40 hours a week. Okay, how much is each owner getting? How much would it cost as a fair market salary for each one of those owners? Which one would be better to be replaced? Because what we're going to do is we're going to add back one of those owners' salaries, but not both. But we might add back partial because they might be overpaying themselves.
Right.
Or we may add back we might do a negative add back because they're not paying themselves. That second partner is not getting as much what it costs for an open
and you see that pretty often
market.
So if it's a husband and wife team, and let's assume my wife works at Carey's car wash, okay, and she does the books. Mm-hmm. Well, I pay myself $50,000 a year. We pay her $50,000 a year. I can get a bookkeeper for way cheaper than $50,000 a year.
A part-time bookkeeper.
A part-time bookkeeper.
Yeah.
So we're not going to add back both of the salaries, but we will add back
your salary,
my salary, and the excess of what it would cost to get a bookkeeper. If the bookkeeper costs $20,000 a year, we're paying my wife $50,000 a year. We'll add back $30,000.
Exactly. Exactly.
So that's kind of how it works on that regard. But a lot of times we see people paying themselves way too much for a salary or not enough for a salary, and we have to do some.
We have to do some adjustments like that for when we're talking about replacement. If it's a single owner operator and they're working 40 or 50 hours a week, we just add back their salary. It's straight. It's easy. It's simple. When you start talking about partners, things like that, that's when it gets a little bit more complicated. Or if the owner is only working 5 hours a week and they're collecting a $50,000 or $75,000 owner's salary, we can add back their salary, obviously, but it's only 5 hours worth of work. And we're assuming that whoever buys the business is going to, in a discretionary earnings situation, we're going to assume that they are going to be working that business full time as an owner operator. So we would then look at the manager's salary and say, okay, would they be taking over the manager's salary and how that would affect, or maybe not even the manager's salary, because sometimes that manager is so critical to the business that we look at the person underneath there.
Yeah.
But when I say that, we want to be careful of that, because when we're selling a business, we want to have the labor force in full. So it's not so cut and dry. These are conversations that we have with sellers and how we're going to work this and do this so that it's best for the owner, it's a good situation for the employees, and it's also a realistic, reasonable situation for the buyer that's coming in.
No doubt. And that's why, I opened up saying it's very situational. You have to look at who's buying the business, because they are going to place a different value on it. And that is a perfect segue to talk about EBITDA a little bit.
Yeah.
Right? So we talked about owner salary, and I think one of the biggest items when we're comparing EBITDA and discretionary earnings or seller's discretionary earnings, SDE, is that owner salary. We use discretionary earnings, or SDE, DE. We throw these terms around all the time, but we're talking about the same thing here. Is assuming that we are kind of selling a job. Because if I'm selling my business as an owner operator to a person who's going to come in and do exactly what I'm doing, it is used as a discretionary earnings of what that owner is going to do. So for EBITDA, we see this for businesses that are maybe lower to middle market, sometimes some M&A level transactions, higher transactions where private equity firms or venture capitalists are coming in.
Strategic buyers. Family offices. Yeah.
And they may not be buying the business with the intention to run it themselves. They are going to have to appoint a CEO or operator to run the business on their behalf, in which case you need a replacement cost. Okay? So we talked about owning or adding back the owner's salary in a discretionary earnings. In which time, now when we work with EBITDA, how would we treat or adjust, a recast, if you will, for an EBITDA?
Yeah, so, and when we're talking about EBITDA, I do want to say that it's really not EBITDA for you CPAs out there or financial experts out there. It's actually adjusted EBITDA.
Right.
So when we're recasting a business to see what the bottom number is, discretionary earnings or adjusted EBITDA, we're doing it exactly the same way. We're recasting the same way, except for discretionary earnings, we're looking at that business and the size of that business, and we're saying the most likely buyer for this business is somebody that's going to be an owner operator running the business themselves. Whereas the larger businesses, we look at and go, this is a business that's going to be more like what you said, private equity groups, family offices, strategic buyers, institutional buyers are going to come in and buy that business, but they're going to put a manager in place. So the only difference between those two is that we're taking out the owner's salary in the discretionary earnings, and with adjusted EBITDA, when we're going off that number, what we're doing is we're putting a salary in there, a fair market salary in there for somebody to run that operation. And so what ends up happening is your discretionary earnings number is going to be higher because you got an owner's salary in there. The EBITDA number, the adjusted EBITDA number, is going to be a lower number because you're taking money out of there for the new buyer to hire a manager to operate that business. Now, if you are listening to this, everybody is out there, you might have a business that's going to sell for 15, 20 million. You're like, I want the discretionary earnings number. Let's do it off of that. When you come back and you do the comparables of businesses being sold, the smaller businesses, you're comparing industry types versus the same industry type of businesses that have actually sold in the same gross sales of the same size range. So the EBITDA multiplier, even though the adjusted EBITDA is lower, the multiplier for that is bigger.
Yep.
The discretionary earnings number is bigger than the adjusted EBITDA number, but the multiplier is going to be lower. and if that makes sense.
It does, and it's a very clear-cut way to put it. And before we get into multipliers, I'll take essentially what you just said and apply it to Carey's car wash again.
Okay.
I'm really into my car wash today.
You are into your car wash today.
I actually wanted to own a car wash for a long time.
That's a good business done.
It is. And this actually won't make sense because no car wash CEO is making a ton of money unless they own 30 of them or 50 of them. But so I said I'm paying myself as an owner-operator of Carey's Car Wash $50,000. But we're going to price it for an adjusted EBITDA number. And the fair market value for a CEO to run a car wash is $100,000.
Let's say you're just throwing a number.
I'm just throwing that number out there, which means we would have to make an adjustment, a negative adjustment, to where the replacement cost would be $100,000.
Yeah.
So, that number that's on the bottom line, the EBITDA number for Carey's Car Wash is going to be lower than the seller's discretionary earnings because we have to bring somebody in at fair market value. So, that's really the difference between the two.
Yeah, yeah. And you know what? I know you touched on it real quick, but I wanted to point it out as well. You're going to hear discretionary earnings. You're going to hear adjusted net. You're going to hear owner benefit. You're going to hear seller's discretionary earnings. All those terms are discretionary earnings. They're all the same. I really wish our industry would get on the same page with using the same terminology, but different parts of the country, you're going to hear different things, but it's all discretionary earnings. And then you have the adjusted EBITDA.
So whether you're doing adjusted EBITDA, over here is 1, or 2, which is discretionary earnings and all of those subsidiaries that you mentioned, we are essentially taking a multiplier against those two numbers, or it's really 1 or 2 of the numbers, whether we're doing EBITDA or discretionary earnings. So, a rule of thumb is a 2-time multiplier, a 3-time multiplier,
4 or 5.
4 or 5, it depends. Yeah. And like you said, EBITDA numbers are going to be a little bit higher, and a discretionary earnings multiplier is going to be a little bit lower.
And on top of that, to add to that, the bigger the business, the higher the multiplier is.
Absolutely.
So I don't sell businesses as small, but if a business has got discretionary earning number of $60,000, you might be looking at a 1.5 multiplier. And please don't take those multipliers. I'm just throwing stuff out. Every industry is different. Let's just say it's a 1.5 multiplier. But if you're making a few $100,000, you might be up to a 2 or 3 multiplier. If you are doing $1 million plus, you could be at 4 or 5. It could go. It depends on the industry. Just some
Absolutely.
industries are more in demand than other. But just what I'm trying to get across to you is the bigger the business, obviously you're making more money in discretionary earnings and or adjusted EBITDA. But you're also, that multiplier is going to be getting bigger as well.
Yep. And let's talk about some of the factors that influence multipliers. The first thing that we typically do is we will look at industry data and comps. So if we have a business and we've determined that it's got a $300,000 discretionary earnings, we want to go look at same businesses or similar industry, same industry, businesses that have sold in the past or are on the market currently, and look at within the same size. So if it's a $300,000 discretionary earning business, let's say they do $2 million in sales. It's a decent profit. So maybe. So we're going to try to find, and let's assume it's a car wash. We're going to look at car washes as well that have gross sales around the same amount and a net profit around the same amount, or discretionary earnings in the same amount. And we're going to look at what they've sold for in the past month, 6 months, 12 months, 24 months.
I sometimes I'll look years back.
There's not always data recorded for us. Like,
right.
You look at comps and
car washes would be pretty easy to find comps on for us, but sometimes you come across businesses that you might have to go back 15, 20 years for data, and that's okay because it's I know it's a shock because residential real estate, you might be in a situation where hey, you're only looking at houses that have sold in the last month or two. But you can look at businesses that sold many years ago and still look at those comps because the multipliers don't typically change that much. Yeah. A business today will sell for a lot more than it did in 2020 because it's inflation. You know what I mean? The same business size that did, let's say, $1 million in 2020, with inflation and everything like that, comparably the same size as cost of living and everything. Maybe it's doing 1.5 or 1.7 million now, but the multiplier that you're using will stay the same. Now, you do have to look at unusual situations or circumstances that could be coming into play. I'm here in Orlando, Florida, and I remember a few years ago when they were building the Amway Center in downtown Orlando, they purposely, and I thought this was really smart, they purposely did not build the parking lot big enough, because what they wanted to do is they wanted the people to, go through downtown when they're going to the events and things like that. So when they did that, and they had the plans that this Amway Center was going to be built, bars in downtown Orlando were selling for a really, really high multiplier. Yep. And that was an adjustment there. And I remember many, many years ago in England, they were playing a reality show. And they were watching people buying businesses in the United States and coming over here on what's called an E2 visa. And again, these are smaller businesses. I don't deal in this world anymore. But they were buying businesses. Lawn businesses was a big one, because the reality shows were the first couple. They followed people that were buying lawn businesses. So what ended up happening is everybody in England that wanted to move here and get an E2 visa, they all wanted a lawn or a landscape business. And so the multipliers in Florida on lawn and landscape businesses have gone up. So when I say you can look years back, you have to look at those what's going on, the environmental factors that could be increasing those market in this, but it's not. That doesn't happen very often. Like today, HVAC businesses. There's a roll up going right now in the HVAC industry. So the multipliers with HVAC businesses are
skyrocketing
through the roof.
Well, yeah, and it's funny, you look at, and this was a COVID effect. This is an environmental effect, right? So people are at home, they're looking at their home, they're saying, what can I improve? Maybe they need to get their ducts cleaned. Maybe they needed, they're in their home more, so their HVAC is being used more, and their air conditioning unit's going bad. So many different things that you have to take into consideration for multipliers. We talked about environmental, but there's also political, there's economic factors, but there's more factors that I think relate directly to multipliers going up and down. I want to touch on some of those as well. You sell a business and it's got an incredible profit margin, incredible discretionary earnings or adjusted EBITDA. It's been in business for 14 months. They filed one tax return and they started the next year with a positive trajectory.
Hard business to sell.
But certainly not going to have as high of a weighting on the multiplier, because it doesn't have history, it doesn't have tenure.
Yep.
We mentioned businesses with owner involvement in other episodes before. Carey's Car Wash. If I'm a completely absentee owner of Carey's Car Wash, probably is a little bit more valuable. Maybe there's a little bit more emphasis on that multiplier because I'm completely absentee.
Or, if you're looking at that business and it's gradually growing year to year to year, that's great.
Yep.
But if you're looking at that business and the numbers are going down year to year to year, obviously that's not going to be as attractive to a buyer. So that could play a big part in how we apply that multiplier too. And what we do a lot of times too is if we are seeing a business going really high up, or there's a big discrepancy between the years, we'll do a weighted average.
Yep.
We can use a variety of different ways to do a weighted average, but let me just give you an example of a weighted average. But this isn't the only way. But maybe you take, it's 2024 right now. Maybe you take 2023 tax returns and you take the discretionary earnings and you times it by 3, and then you take the 2022 tax returns, the discretionary earnings, and you times it by 2, and then you take the 2021 discretionary earnings, you times it by 1, you add all that up, and you divide by 6, and that gives you a weighted average, giving them more weight to the 2003, and then the back years. So it's not really scientific, foolproof, like you said earlier, that hey, this is the price, this is what everybody's going to agree on. There is some subjectivity in there, and that is why it's critical to be working with somebody that is very, very seasoned and experienced in selling businesses, so that they can come up with that price where you can, as a seller, you can maximize your sales price, but not overprice it where it's going to kill you on the marketplace, because that's the number one thing. Number 1, number 2, and number 3 reasons that Carey and I spoke about. But at the same time, we don't want to leave money on the table as well.
Yep. So. And again, it's an opinion of value to come up with the most probable selling price. So you mentioned weighted averages. Somebody reached out to me recently to sell a business, and they had, I think 2021 was like $1 million owner benefit. 2022 was like $1.1 million maybe, I think it was, and then last year was like 2.5. And on their books for next year, just looks like a normal year. Doesn't look like anything special, but they want to maximize last year's value. And they don't want to look at the previous 2 years to do a weighted average. And I said, you could do that, but everybody's going to come in that wants to buy that business, and they're going to say, well, what did it do historically the past 2 years? What is this increase in revenue that you had in profit? Why did that happen? It's not going to go overlooked. So on the front end, when we're doing those weighted averages, we're looking at those spikes, we're looking at those dips, we're trying to normalize them, and it does affect the multiplier used for
it does. Carey, it's as simple as this. When a buyer's buying that business or they're looking at that target business, they're looking at risk factors.
Yes.
And the more risky it is, they even if the numbers are climbing greatly year to year to year, they might be like, if it only happened the last 2 years, like, they were going 20, 21, 22, and then all of a sudden 23 was up here, it'd be like, hey, 23 is great, but they're like, but is it going to continue?
Yep.
Like, what was that reason why it went really up? There, you look at that risk factor, that's what buyers are looking at, is what the risk factor at the end of the day.
Yep. And then other points that directly relate to this is customer concentration, right? A lot of times when you have a customer that makes up 60, 70% of your revenue, that's scary as hell for a buyer. That's a huge risk factor. Maybe look down on the multiplier. And then something that brings the...
Once you get over 15% in client concentration versus your revenue, I'm not saying you can't sell it, but those are conversations that we have to figure out how we're going to, not just with the pricing, but how we're going to handle that sale so that we can put a buyer at ease.
Yep.
Because they're afraid they lose that one client. And again, it comes back to risk. They lose that one client, and if they have 60% of the business and they lose that one client overnight, a week after they buy it, it's not a good situation for the buyer.
And conversely, I think something that increases the value or increases the multiplier is strong contracts. So if I were to go buy a business tomorrow, I want to buy a business with recurring monthly revenue.
Yeah.
Contracts that are 3, 4, 5-year contracts with recurring monthly revenue. It hits the bank account every single month.
Same clients every month hitting that money.
Security businesses, long contracts. They're usually not very long, but...
Yeah, and also they usually have an out clause anyways.
Yes. But when you can have that recurring revenue or contracts with government agencies or large institutional companies, Fortune 500 companies, that lowers your risk factor.
Buyers love recurring revenue. I think the only thing better than recurring revenue is royalties. Because you do something once and you're collecting off that same thing for many years to come. But I don't run across royalty type situations.
A couple other factors that may increase multipliers up and down, maybe lease terms with a landlord. Maybe you don't have a lot of lease term left and you have to go negotiate a new lease, and you're going to have a huge adjustment in what you're paying in rent. Maybe that doesn't affect the multiplier, but it's definitely going to have an impact on the profit on the bottom line. Talk about capital expenditures, amount of working capital that you need, inventory that you need to keep on hand. These are all things that are taken into consideration when we're factoring in a multiplier.
And I'm also looking at, too, when we're looking at making the discretionary earnings or the adjusted EBITDA, we're looking at all the other financials as well. The three biggest expenses that you usually see in any kind of business is cost of goods, labor, and rent. Those are the three biggest expenses. So when I'm looking at a business owner's financials, once I get those financials, I look at the gross sales, I look at the net profit, and then I zero in on those three major expenses. And I look at it, I'm like, cost of goods, okay, what's the percentage of cost of goods? Because that's a variable expense. What's that cost of goods for the last 3 years from a percentage standpoint? If it's 32%, 33%, and then the most current year, it's a 5% or a 10% cost of goods.
Red flag.
It's a red flag, and it's going to be a red flag to a buyer. So when you hit a situation like that, you start thinking, okay, the business owner's probably not been ordering the inventory because they're getting ready to sell, and they're using up past inventory, which is artificially increasing their profit margin. That's a buyer's not going to buy into that.
No.
So we would have to have that conversation about the cost of goods and put a cost of goods number in there that makes sense. The labor cost, same thing. What's the labor cost percentage versus the gross sales? Is there a huge, 1 year it's 30%, the next year it jumps up or it jumps down a lot? Why is that? We're looking at that. And rent is a fixed expense. So you can't really look at percentages because the more you do in gross sales, the less percentage versus gross sales that rent number is. But I always look at rent because rent is one of the bigger expenses, and sometimes, unknowingly to the CPA, the business owner may have prepaid their rent or gotten behind on rent or whatever it is, we would have to normalize that rent. And then after that, it's going through every other single line throughout there and comparing it year to year to see why there's fluctuations. And one big one might be legal and professional expense. If 1 year all of a sudden I see legal and professional expense and it's $5,000 or $7,000, and then in 1 year it jumps up to $50,000. Why?
Lawsuit.
Is there a lawsuit going on? These are the things, because we're not just valuing the business. We're trying to look at this from a perspective, we're going to be taking this business to the market and we want to get it sold. And these are the questions buyers are going to have. So it's good that we're uncovering all this.
And it's all about uncovering everything from the step one, because what we're doing is we're benchmarking data. We're looking at a history of financials. And like Jim was saying, if cost of goods over an X amount of year period, there's an anomaly, let's normalize that anomaly. Or if there's a huge expense, let's figure out what that expense is. Is it going to happen again? So it's all about analyzing the data and benchmarking.
And what Carey means by benchmarking is he's talking about benchmarking it towards the industry. So what we're looking at the subject business, and we're looking at that. And we're looking at sold businesses. What were their percentage of cost of goods? What were their profit margins? What were their labor costs? And how does the business that we're looking at, how does that compare to those? Are they beating the profit, or are they not beating the profit, percentage? And if they're beating it by a lot, or they're getting killed by it, why? You know what I mean? We're trying to uncover that story. So that's what benchmarking is when you're taking a subject business and comparing it to other industries.
Now, you also could benchmark against your historical financials, right? Because you mentioned cost of goods going down 1 year. So if a business is operating at 30% cost of goods and now they're at 5%, well, what's happening in this business? But benchmarking against industry data, we may have 10, 15,000 businesses that have sold in the past 10 years in this particular industry. How is subject business that we're pricing compared to all of the industry data? Do they have an incredibly low cost of labor? Well, why is that? So we're asking the why on every single line item. And my question to you is, because I have my way that I do it, which mostly I've learned from you, but you're interviewing a new business owner. How many years back are you going in financials when you're, and I know there's a little bit of a caveat with COVID because that's changed the industry a little bit. But in a normal sense, how far do you go back? Is it the typical 3 years?
Yeah, I'll go back 3 years, potentially 5 years, depending on the business. I like going back 5 years because it gives me more of an idea of what the trends are. But like you said, with the COVID situation, we're in 2024 right now. We're looking at 2020. And, it was COVID situation. Some businesses got killed during the COVID. Other businesses thrived. And I kind of look at 2020 now, and I've talked to business appraisers about this too, and they're on the same mindset as I am. At this point, we just need to not look at 2020.
Post-COVID.
We're enough out of that situation that we got 21, 22, and 23 to look at. And if I'm going to look, I'm not saying I won't take 2020 and look at it. I want to understand what happened in that year, but maybe take 19 and 18, and
And that's what I did recently for a business that got crushed in 2020. 2021, they were still recovering. 2022 was almost the identical net profit to 2019 and 18. So you remove those years from it. It was an anomaly that it happens. Yeah. But there's so many different scenarios. But typically we look at about 3 years of financials in the current year when we're going to go ahead and put a value on a business, an opinion of value. Another point I wanted to bring up is, and I had a really challenging ordeal with a seller where I gave them a broker opinion of value, and they kept saying to me, well, you're not taking into consideration my distributions.
Oh, gosh, Carey, that's a great one. Go ahead. Yeah. That's a great one.
So, and this will be another session where we talk about the difference between a balance sheet item and a P&L, but your profit and loss is how your business is operating, right? The balance sheet is a different financial instrument that's used.
We don't mix them too. We'll recast the balance sheet, but we can't mix them.
Exactly. So if an owner is taking distributions from their business, they're taking the distributions from the net profit on their profit and loss statement, right?
It's not expense.
It is not expense.
It's coming out of the net profit.
If you have $100,000 on your bottom line and you distribute that $100,000 in profit to you don't get to double dip. You don't get to take that $100,000 in profit that your business had, and the fact that you wrote that check to yourself instead of retaining the earnings, you don't get to double dip that.
Right.
So, a lot of times when somebody says, I take a $50,000 salary and they don't have profit on the bottom line, they go, well, I wrote myself a huge check. Okay.
I can show you that canceled check.
Yes.
I hear that. Yeah.
So, I don't know if there's anything else you want to add to that, but distribution, since they are typically a balance sheet item, since they are typically taken from the profit that is on the bottom line of a profit and loss or a tax return, it is not counted as additional value to the business.
Yeah. That's a good point. I want to bring up another one is unreported cash. Because I look at it, and I know you look at it, unreported cash. If you're bringing cash in the door and you're not reporting it on your tax returns and P&Ls, I'm going to ignore it. I'm going to totally ignore it. We're in a different world.
Yeah.
I got into this industry 25 years ago. A lot of industries, some restaurants, retail. We're talking about a lot of businesses today that I sell different kinds nowadays. I'm not big into the restaurant world anymore, but back in 25 years ago, 50% of the revenue that the restaurant brought in was coming from cash, and 50% was coming from debit card, credit card. And today, it's like 80, 90% is coming in from debit card, credit card, 10, 15, 20% is coming in from cash. And 25 years ago, the buyers had a different mentality. They would buy into the cash concept.
A cash log was acceptable.
Yeah.
A little notebook with plus $300.
Today's buyers, they want to see. I think back then they were street smart, and they would figure out how much that money that business was making other ways, and that's a whole nother story. But today's buyers are more sophisticated. They want to see. I shouldn't say sophisticated. It's probably not the right word, but they want to see tax returns, bank statements. They want merchant service statements. They want to see that. They want to see reported income.
We're in a world
ignore cash.
We're in an information age, and data is readily available for us with computation and AI and everything. So, if the data is available, we're going to analyze it. And the cash logs and the cash in and out is typically something that is not logged, unfortunately.
Just ignore it. We're going to ignore that cash.
Yep.
We're going to ignore that cash. And you know what?
Cash
you're not
is king.
You're not going to get credit for that cash that you're not reporting. And so, start reporting that cash. I mean, one, you're creating tax fraud. I'm not judging. I'm just saying there's risks to you from the government if you're doing that. So I highly encourage you, start reporting your cash. But also look at it this way. Let's say that for every dollar that you do not report, you are saving 30 cents in taxes, for instance. Well, when you go to sell that business, for every dollar you're not reporting, you could be losing $2, $3, $4, $5, $6 in the sales price for every dollar. So you're trying to save basically change, and you're leaving dollars on the table. So
that is a perfect way to provide that example with whole numbers. And it's just like we were talking about, you can win one time. And if there's one piece of advice that we could leave our audience with today, it's if you're preparing to sell your business, you want to try to have the cleanest books that you possibly can. You want to try to log every single dollar that you make. We're talking about cash. Show your cash. People start businesses, or should start a business, with an exit plan, with one day to sell your business, build your business, build it up, and eventually sell it one day. The easiest way to do that is have a nice set of books. Don't run personal expenses through it. Make sure it's very clean. Make sure you keep track of everything. You want to get the highest value for your business. These are some of the rules that you're going to want to play by.
And Carey, for those business owners out there that are sitting there listening to this and you're saying, I'm not going to be selling my business anytime soon, I don't plan on doing it. You never know when you might have to sell your business. It was probably about 10 years ago I got a phone call from a very nice woman who her husband owned a blue collar type business, and they went out, and I don't want to talk about personal stuff, but he unexpectedly passed away, and she had to sell the business immediately. And you never know when you're going to run into a situation like that, and it might be you that you have health issues, or your spouse gets offered a job out of state that they can't turn down, or if something happened to you, unfortunately, and your spouse or somebody in your family had to take care of disposing your business, and you should always be ready for the business to be sold.
That's a great point.
I'm sorry for
that's a great point. And I think in summary, we talked today about pricing strategies, things that influence multipliers to go up, multipliers to go down. We talked about how we come up with add backs, how we analyze financial statements and prepare a broker's opinion of value. Again, it's a very subjective and convoluted process, but we've been doing this for years. We love doing this. It's actually fun for us. I love looking at different financial statements and industries. But we are here to help any business owner that is interested in finding out the opinion, our broker's opinion of value of your business. Again, it's not at a cost to you, and it's something that we have a lot of knowledge and expertise doing, and we'd love to help you if you're interested in learning about the value of your business.
And I want to let you guys know too, like, this video is not here to teach you guys how to do a broker's opinion of value. The association, there's a very large association out there called the International Business Brokers Association. They have a 2-day course. They spend 3 days actually, 3 full days on how to do add backs and price a business. And it's a 24-hour course. We can't sit here for 45 minutes to an hour and teach you how to price a business. And it's not even that 24-hour class. It takes years and years and years of experience and hundreds of transactions, or doing hundreds of brokers' opinions of value. You just keep getting better and better and better, and you know what to look for and what the buyer is going to overcome. So today we're just trying to give you an idea of how Carey and I and other brokers will do add backs and how to price a business. But please, you're not going to walk away from this video going, yeah, I know the value of my business. One, you're missing the multiplier concept. I mean, we get those multipliers from different databases that we belong to, that we spend a lot of money on to have access to that information. But even if you had access to that information, you really need it to be done by somebody that's experienced and seasoned, that knows what they're doing. Because you could be doing your add backs wrong, or you could be applying the multipliers wrong.
Absolutely. It's a great point. So hopefully the audience picked up a little bit on how we do it. So it's not just a number that's put in front of them. Now they have a little bit of basis behind it. But thank you so much for joining us today. We really appreciate you taking the time to listen to Boss Talk.
Thank you very much.